Hello, everyone. Welcome to video 2 on our discussion of Chapter 11. Before we get back into it, I wanted to emphasize that these particular deductions that we're seeing are categorized as being Division C deductions. Division B deductions are things that help us calculate our net income, things like moving expenses, childcare expenses, RSP deductions. These deductions, the stock options, capital gains deduction, our loss carryovers, these are for Division C. Yeah. So I just wanted to emphasize that difference because in here, all of these steps gets us through our Division B income, but Division C is the consideration of deductions that gets us from net income to taxable income. Continuing our discussion, we were talking about transaction-based and source-based losses. Discussing loss carryover and tax credit. So let's say we have some excess losses, we can carry them over. Although all of our losses must be applied against our income or gains in the year we earn them, once they reach that status of being a carryover, we can choose how much we use in a given year. So we can, if we have a $10,000 net capital loss, we can pull 3,000 of it and put it into last year and hold 7 and put into next year. So we have a lot of choice on how much we will transfer. So an individual should not use loss carryovers to reduce taxable income to nil because of the availability of non-refundable tax credits. The thing about non-refundable tax credits is they can be used to reduce your tax obligation. They reduce your tax payable. But if your income gets to zero, or once that tax balance owing gets to zero, any remaining credits are lost. Any unused amounts just go by the wayside, fade into the ether, and then next year we'll get a new set of non-refundable tax credits, like the basic personal amount. So the idea is we don't want to miss out on these tax credits if we don't have to. So we'll figure out how much of our tax obligation will be covered by the tax credits, and then we'll only use our losses to get our income down to a level where the gross tax payable will match the tax effect of the credits we get to use. So to use these carryovers to the maximum efficiency, we don't need to worry as much about getting our income to zero as much as we want to get our tax liability to zero. If you are using a tax software, many will automatically advise filers that a lesser amount can be claimed because of tax credits. So the interaction between Tax Act Section 3 and loss carryovers. If this person has employment income of 37,000, taxable eligible dividends of 6,900, saying $5,000 received, grossed up by 38%, taxable capital gains of 3,800, allowable capital losses of 9,000, rental loss of 17,000, business loss of 42,000, deductible moving expenses of 23. So we have a series of different incomes, a series of different losses. How would we apply these numbers? We'll take our employment and taxable dividends, 37 plus 6,900, and we'll add them together. Now we have our income of 43,009. Our taxable capital gains were 3,800, but our allowable capital losses were more than that, 9,000. So once that income portion gets to zero, we stop there. Anything that's left over will be carried forward. So 43,009, we have nothing to add to it, 43,900, but we can subtract some moving expenses, 2,300. That gets us to our income amount of 41,600. From this number, we can subtract our business loss and rental losses. That brings our income to zero because our losses are more than our income. We can't get below zero, so we stop at zero. Anything that's left to be subtracted becomes our non-capital loss. So Income Tax Act 3D requires full amount of current year losses. We have to use the losses as much as we can in the year earned. No negative numbers are allowed. The 2024 net capital loss is $5,200. That's our 9,000 minus our taxable gain of 38. Our non-capital loss is our $59,000 minus the amount of income that we removed. That leaves us with 17,400 left. So this example illustrates that same calculation. This style, this order that we use is the same section 3 calculation we did in chapter 1 of the textbook, if you can remember back to the tax 1 course. So we have net capital loss, we have non-capital loss. If we want to carry them over, non-capital losses can only be held for 20 years. They can only be held for 20 years. So after 20 years, if they're not used, they're lost, but they're not streamed. So hopefully within 20 years, we have income from somewhere. Because if we do, then we can use up those non-capital losses. Net capital losses can stick around forever, but they're streamed. So we can't use them until we find a related income type, a taxable capital gain. Fishing and unrestricted farm losses, 3 and 20, very similar to non-capital. They're also, these types of unrestricted farm losses are also not streamed. They can be applied wherever. So we have this time restriction. We have a time restriction, but we're not restricted in how we use the losses. Any income amounts can be subtracted. We have restricted farm losses that can only be used against farm income. It has the same limitations as non-capital unrestricted farm, but it is streamed. You need farm income. Limited partnership losses cannot be carried back, but they can carry forward forever. They are streamed. Listed personal property is it has the shortest time frame. It can go back 3 years, forward 7, but you can only use those losses when you have LPP gains. So of our various losses, the most limited one is that listed personal property. So if you're wanting to invest in coins personally, if you think you might have a loss, you might want to prepare yourself to have a gain within short order of that time frame, because you want to be able to use those losses. So non-capital losses are of one of the 2 types that are not streamed. Non-capital loss and unrestricted farm losses are source-based. Neither are streamed. I'm not going to worry about the technical definition of more complex situations. So calculating the non-capital loss formula is this. It's simply A minus D, but A is made up of E minus F. E is the sum of office, employment, business, and property losses. Now, business includes all types, whether farming or fishing. It also includes ABLES, net capital loss deducted, capital gains, deduction claimed in year, and other deduction amounts. So what we're doing is we're combining all of the losses that we're using in a given year, and we compare it to what is our income amount. If the losses are more, then we're going to have a carry forward function. So that's our A. A is our non-capital loss amount. Well, it's our total amount of losses. The minus D is simply to pull out the unrestricted farm loss. So we have our full list of losses. We subtract our incomes that we apply them to, and then we have to just portion of our total losses. This much is non-capital, this much is unrestricted farm. So that's all A is doing. Really, the formula is E minus F minus D. So in 2024, Harry Rhodes has employment income of 20,000, taxable capital gains of 30,000, a non-farm business loss of 60,000, and an unrestricted farm business loss of 6,000. So we have $50,000 worth of income, $66,000 worth of losses, and we also collected workers' compensation of 8,000. So our employment income plus our workers' comp adds up to $28,000. We had taxable capital gains of 30,000. We're not told of any allowable capital losses, so we'll ignore that for now. Our total income is $58,000. From our business losses, we had $66,000 of losses between our business and farm. So our 58,000 will subtract 66. We have excess losses. So amount E is 74,000. That is $60,000 plus $6,000 plus $8,000. Now notice that that $8,000 doesn't show up here because what it is the workers' compensation gets added to income for reporting purposes, but it'll be subtracted again for taxable income. There's no taxes on workers' compensation. So, um, so even though it's not a loss, we'll still include it with our business losses when calibrating E. So E is 74,000. F is $58,000, 20,000 plus 30 plus that 8. So that employment comp is coming in as both an income and a deduction. The amount of D is our farm loss, $6,000. So our non-capital loss is just the difference of 10,000. 74,000 minus 58 minus 6 comes to 10. Carryover is only available after the current year's income is reduced to nil. Now, we mentioned before that it's not the best idea to get income to nil. The only thing is when these losses are earned, we don't have a choice. We have to use them as much as we can before we'll be allowed to carry anything over. So oldest non-capital loss is deducted first. Since non-capital losses only last 20 years, if we have a few years of losses, we want to use up the old ones before they age out. Because if we can use up those, we've bought ourselves more time to use up the others. So exercise 11-2. Non-capital losses. In 2024, Janice McMahon has employment income of 35,000, net taxable capital gains of 13,000. In addition, she has a non-farm business loss of $58,000 and an unrestricted farm business loss of 22. What is her 2024 non-capital loss? So I have this brief summary here just to show the numbers we're applying. Our employment is 35,000. Our net taxable capital gains is 13,000, and our business has a loss of $58,000. So because this is calculating a quick calculation of our non-capital loss, so since farm losses are separate, I didn't include it in this calculation. When we apply our incomes against our losses, we net a loss of $10,000. In the format of our E minus F minus D, it'll look like this. Our business and farm losses will be combined to say 60,200. There's our E. From our E, we will subtract the income that we're applying the losses to. Employment's 35,000, taxable capital gains of 13. So our total income's 48. 60,200 minus 48 is $12,200. So this is the total net excess loss for this year. The only thing is not all of this loss is non-capital. We will subtract out the farm losses that weren't necessary to be used. And that gives us, so we will carry forward $2,200 in unrestricted farm losses and $10,000 of non-capital loss. So we've talked about non-capital loss, now net capital loss. Review. Excess, if any, of allowable capital losses over taxable capital gains. Term refers to the deductible portion of capital losses, not the full amount. So because capital gains and losses apply at 50%, we're always taking our full transaction amount and then halving it for our consideration. So if I have a capital loss of $5,000, $2,500 is what we're concerned with. Carryover is back 3 years or indefinite into the future until a person passes away, restricted to amount included as positive in Income Tax Act 3B. So net capital losses are streamed. We can only apply them against taxable capital gains. But so because net capital losses can only be applied against a certain income type, what if we no longer have assets? We sold our last one, we had a loss. Now we're not going to have any future gains. Well, maybe there's something we can do to convert that net capital loss to a non-capital loss to make it more useful. In 2024, Martha Stewart has employment income of $50,000, taxable capital gains of $90,000, and a business loss of $300,000. She also has a net capital loss carry forward of 120,000. Now we have capital gains of 90, so we'll be able to use up most of our net capital loss. Martha will deduct as much of the net capital loss carry forward as she is allowed. So the employment income was 50, taxable capital gains were 90, $90,000 is makes 140. Our business loss is more than we need, though. We can accept the taxable capital gains, subtract the business loss of 300,000. Our taxes are owing is 0, so maybe we don't need to do that. But it's still leaving us with this large capital loss, net capital loss carry forward. So we can use up some of that carry forward. The non-capital loss calculation is 390,000. Our loss plus 90,000 of the net capital loss we can use. We apply it against the $140,000 of income, and our non-capital loss becomes 250,000. So before, you see this difference is 160. So we said, well, since our net capital loss isn't as useful as non-capital, what if we apply the net capital loss to those capital gains anyway? That will reduce our income, increase our loss usage, and that 90,000 will convert from net capital loss into non-capital loss. In other words, by using as much as we're allowed in net capital loss, we leave behind more capital loss for the future. So our total losses is up to 390. The income was 140. The non-capital loss is $250,000. So our net capital loss went from 120,000 to 30 because we used 90 of it. And the total amount of losses, 250,000 plus 20,000 is $280,000. So if there was no conversion, the Martha Stewart employment income of 50,000 in capital gains, despite having a positive income taxable gain amount, we did not deduct it in the year. So if we did it without the conversion, our non-capital loss would be 160. Our net capital loss would be 120. So if we just left the net capital losses alone, then they would just sit until we had gains. But this year we had gains, so we can convert $90,000, the amount of our taxable gains, from net capital loss into our non-capital loss amount. So the consensus is if net capital losses should be used, sorry, let me try that. The consensus is net capital losses should be used whenever there's a positive of our taxable capital gains. The exception is only when the capital gains will be reduced anyway through a deduction, but I'm not going to worry about that just yet. As a tax planning strategy, any loss carryovers that are streamed should be claimed before losses that are not streamed. Our streamed losses are restricted to what we can use them for. So when that opportunity arrives, we use them. And when we use them, we can shift the load from our non-capital loss. So we're not relying on it as much to reduce all that income. So we have two quick exercises I'd like to do in this video. Net capital loss carryovers. Miss Laura Mackey has an allowable capital loss of 15,000, no taxable capital gains, and as a result, she has a net capital loss of $15,000. This was last year. Prior to 2024, she had no taxable capital gains and was not able to claim that capital loss. In 2024, the income was a taxable capital gain of 40,000, so now we can use that net capital loss, and a rental loss of 30,000. She does not anticipate any future capital gains. Determine the minimum net income and taxable income, as well as the loss carryovers between if she chooses to claim enough net capital loss just to get her income to 0, or if she wants to deduct as much as she can. So in either case, we're going to get that taxable income to 0. We have a net capital loss of $15,000. So what if we only deduct enough capital loss to get the income to 0? Taxable capital gains was 40. Our property loss was 30,000. So our net income is only $10,000. So of our 15,000 allowable costs carryover, we can use 10 of it. Taxable income gets to 0. Net capital loss still leaves 5,000 behind. Our losses was 30,000 plus the 10 of our capital loss we used, 40,000 total. Taxable capital gains was 40,000. We have no non-capital loss. So by just using enough to get our total income to zero, taxable income to zero, then we still have net capital loss, no non-capital loss. But we have enough taxable capital gains, we could use the full 15. So in this next scenario, we do just that. We're going to apply the full 15,000 anyway. Our taxable income stops at zero, so it doesn't change our taxable income, but it gets that net capital loss to zero. So now when we go to our E minus F, our total losses is now 30, plus the capital loss we used is now 45. Taxable capital gains is 40. E minus F means our non-capital loss is $5,000. So by using it anyway, we didn't change the tax outcome of this year, but we converted that loss into non-capital loss to make it more useful in the future. There's just one slide. Normally I would probably end the video here, but I have just one slide left of net capital losses, so I would just want to get through it. If a person passes away, net capital losses can be held indefinitely. Upon a person's death, then those net capital losses are deductible against any type of income in the year of death and in the year immediately preceding death. Because at the point of your death, all of your investments, all of your assets are deemed to be sold. This is a year where we might have very exaggerated capital gains or capital losses. So if we're forced to recognize a bunch of capital losses, what does our state do about that? Well, they say, well, you can use them this year or apply them against any kind of income either this year or last year. If the result of our capital loss is because everything was deemed to be sold, then maybe last year we have some income we can apply it to. So capital losses are realized by a state in first year after death. Oh, and so once you've passed away and it turns into an estate, any losses in that first year of the estate can also apply. But that's adding a layer that I don't think you need to be too concerned with right now. We want to focus on just that deduction in the year of death and immediately before. So that is, just the next page. So Derek Barnes dies in 2024. He has a net capital loss from a few years ago of $20,000 at the time of his death. His final income tax return shows net income of $23,800, which includes a taxable capital gain of $7,200. The only personal tax credit on his final return is his BPA of $15,705. Derek had never claimed the capital gains deduction, described the optimal income tax treatment. So in this treatment, we have more loss carryover than our amount of taxable gain. So in a regular year, let's just highlight that slightly. In a regular year, we would be limited to claim the net capital loss of the amount of our capital gains. We'd only subtract 7,200. At 16,600, tax at 15%, we would owe 2,490. Our basic personal amount of 15,705 would confer a tax credit of 2,356. So we would owe taxes of $134. So net capital loss allowed us to apply against capital gains, but our employment income stuck around. On death, we'll make this bold by making it red. We still have that loss of $20,000. So what we'll do is figure out how much net capital loss we can deduct. Now, we don't need taxable income to get to zero because our basic personal credits are picking up a good portion of the load. So if we were to deduct the full amount, 20,000, our tax credit is $570, but we were using over 2,000. We don't want to lose out on those credits. So maybe we only subtract 8,095. That will get our net income down to our taxable income of 15,705. So that matches our basic personal amount. Now our tax calculating matches our tax credits We don't owe any taxes, and we can take that just short of $12,000, 11,905, and we could carry that to the year before. Once we've covered our taxable capital gains in the year, the remaining net capital losses can be used like any other carryover. So we can apply the specific amount we need to get our obligation to zero, leaving as much as possible behind for the greatest use to carry it back a year. Okay, so that is the video on non-capital and net capital losses. Thank you for your time. I'll see you in the next video.